the last part of the question, a lower limited, 3.4, is the lease disclosure. Now this disclosure is, to be honest, quite painful. It's very format driven. You've got to do it in a particular way, and it really is just a bit of a pain. The upside is you have all the figures, so you're not required to do complex calculations, but your presentation here is really, really important. So you need to learn how to set this note out properly. It was made easier for you by the fact that you were given the amortization calculation. It made it a lot easier, but there's no simple way of doing it. It's a bit of a pain. In any event, we will start off with what is the easiest part of it. So we're doing 3.4, and it is the leases note. Now the note is split into several parts. You're unlikely to have to ever answer all of the parts, but you will normally have to do at least 3 or 4 parts of the note. So let's just understand how it's broken down. It's first of all deals with the asset. So you've got the right of use asset, and you need to disclose the typical PP&E information about the right of use asset. So opening carrying value, movements, closing carrying value. That's straightforward. Then you have to disclose the liability itself. That liability needs to show movements for the current year. So opening balance, movements through to closing balance, but the closing balance then needs to be split between short-term and non-current. You could do that separately as well, but I choose not to. Then the third part of the note is the maturity analysis. Now the maturity analysis focuses on the future only. So what the maturity analysis basically is saying is this loan that I have, bearing in mind our balance was 1141862, when is that 1141862 being paid? Over what periods? Okay, and how is it being paid? The last part of the note is then cash flows in the current year, where they are specifically disclosed. And there's a couple of different places where it could be disclosed. Okay, so let's get started with the first part, which is the easy part, the right of use asset. As I said, this looks a bit like the PP&E note, and it in fact is that disclosure. And if you had more than one category of asset being leased, then you would just do multiple columns like you would do in a PP&E note. So we've only got one category, and that is motor vehicles. Again, to remind you, no abbreviating. So it's the same setup as per usual. Carrying value beginning of year, split between cost and accumulated depreciation. Then leave a few lines for your movements, although you only need to leave probably 3 or 4 lines because there's never going to be much happening here, which will then give you carrying value end of year, split between cost and accumulated depreciation. Right, so let's pop the figures in. 1596,000 was the original cost, and the opening accumulated depreciation 319,200, so giving us an opening carrying value of 1,276,800. Then current year movement was depreciation, which you calculated in part 1 of the question. So just pull your figure through, 319,200, and therefore closing figures 1596,000, accumulated depreciation 638,400, and therefore closing carrying value 957,600. And that's the right of use asset. It isn't likely to ever have much more movement on it because it's a leased asset. You can't do much to it in any event. So it's unlikely to ever have much more than that. Right, let's go on to the second part of this note, which is the lease liability side of it. And this you're going to take from your amortization table. So remember what I said, it's a movement analysis. So again, you're going to start with the opening balance. So opening balance from the table, and so you go to the table looking for year end 30 June 2018, and if you go to the table you'll see that the figure was 1387680, and then you have to list the movements. So what we've got in the current year is we've got a repayment which was 420,000, which included the interest for last year, and we've got the interest that was accrued. So quite simply, list both of those. So repayment and interest accrued. The repayment was 420,000, and that reduces the liability, but the interest increases the liability, 174,182. And that's the same interest that that would have been processed to P&L in the income statement. Right, so add the interest, and that then gives us our closing liability, 114,1862. We've spoken about that figure many times, so by now that figure should be familiar to you. But what we do have to do with the closing balance is we have to split it between the short-term portion and the non-current portion. Okay, so the non-current portion, and that we're going to do as a balancing figure because it's just easier. So non-current portion included in non-current liabilities, and short-term portion included in current liabilities. Do the short-term portion first because it's easier, 420,000, and then the balancing figure is the other amount, 721,862. So just to remind you, I'm just going to write in red there, balancing, because you don't even need to think about it, just do it as the balancing figure. And that then gives you, you can just block that, you don't even need to show it because you've got the closing balance, so it's just a split between the closing balance. And then the last part of this little section is the story about the lease. I'm not going to write the story out, I'm going to just start it off, but on 1 July 2017, and then I'm just going to do ... because what do you have to include in the story? You just have to include the terms and conditions of the lease. Okay, so on 1 July 2017, they entered into a lease agreement. The interest rate is 18% per annum. The lease period is 5 years, and the installments of 420,000 are payable in advance. And then there's a final balloon payment on this lease as well. So it's normally about 2 marks, and it literally is just a little story about the lease. When you entered into it, the interest rates, the repayments, etc. You can do that yourselves. Right, that's the second part of this note. The third part of this note is the maturity analysis. Now, this part focuses on the future. Okay, so it's the maturity analysis, but of future payments. So what you're basically telling users is when your balance is going to be paid. So if you think about it, this is a 5-year lease. We've already paid 2 installments, one on the 1st of July 2017 and one on the 1st of July 2018. The next installment is due the day after the financial year end, 1 July 2019. So we've got 2019, 2020 and 2021 left. But what you must just remember is the one payment has got, there's a balloon payment with it as well. So that's what you need to focus on. But remember, it's focusing on year ends. So for the year ended 30 June 2020, that will be the payment that we're going to make on 1 July, 420,000. Then we've got for the year ended 30 June 2021, we've got another 420,000. And then for the year ended 30 June 2022, we've got 2 figures. we've got the 420,000, plus if you go back to the amortization table, you'll see that there was a balloon payment as well. So in total, it came to 509,520. You add all of those up, which comes to 1,349,520. And this part of the maturity analysis has to balance back to the previous part, the 1,141,862. Has to balance back to it. But you can clearly see at the moment that it doesn't. 1,349,520 versus 1,141,862. But remember, we're talking about payments, and payments include interest. So what we have to do is we have to subtract the interest component of these payments, and that will then reconcile us back to the 1,141,862. So we subtract future finance or interest, it doesn't matter what you call it, costs, and those figures you will take from the amortization table. It was 129,935 plus 77,723. You add those two figures together, comes to 207,658. And if you then subtract that from the 1,349,520, you get the capital portion. So it's the future interest payments. And that's the maturity analysis done. Okay, so the last part of this note is the cash flow. And it is only cash flow for the current year. And there is very specific places as to where the cash flow has to be disclosed. So let's just talk about cash flow for a minute. Cash flow, we've got three sections to our cash flow statement: operating, investing, and financing. And we know, or you will learn, that there are sometimes choices. So for example, interest paid could be disclosed under operating, but it also could be disclosed under financing. Interest received could be under operating, but it could also be under investing. With leases, the specific places that it has to be disclosed. So the interest side of it is disclosed under operating activities, and the capital portion of each payment is disclosed under financing. But remember, we are focusing on cash flow. So it's payments in the current year. So on 1st of July 2018, we made a payment, and that payment is in the current year. But that payment includes the interest for last year. So this year's payment, you have to use last year's interest from a disclosure point of view. So what does this part of the note look like? Well, you have to say where we presented it. So presented under operating activities. And that is cash payment for interest on lease. From your amortization table, last year's interest, 211,680, and presented under finance activities, and that is the cash payment for the capital on the lease. And you can either use your amort table for that, or you can just do it as the balancing figure. It doesn't make any difference because you know what the total was, 208,320, and so the total came to 420,000. So it's only focusing on cash flows in the current year, and because we're in the second year of the lease, this is the only cash flow. You just need to be careful. When you take out a lease, sometimes there are other cash flows. For example, initial costs of taking out the lease. That is also cash flow in the first year of the lease, but obviously won't recur later. So in this instance, it was only 420,000. And that is the end of the lease liability note. That is the end of 3.4, and that is the end of the answer to this question.